Good afternoon, everyone. It's Make a Move Mike, aka Michael Harris of Realty Executives Dillon. Today I'm here with Andy Cruz of Mortgage Heroes, and we're going to be discussing today what interest rates should I expect when I'm applying for a mortgage. So there are several factors that tie into that. Number one is your debt to income ratio. Number two, your credit history. And number three, the type of loan product that you're applying for. So Andy's going to go into further detail about those things, and without further ado, here's Andy.
Well, this can certainly be an easy topic in some regards and then kind of complex in others. So let's unpack a little bit of what Mike already led us into, which is first and foremost is credit. There's buckets of credit, right? People have a 640 or a 660 or a 680, 740, 780, 800. And so that bucket of credit will actually give us a really good insight as to kind of what price range you're going to fall into when it comes to interest rates. But that piece alone doesn't tell the whole story. That's coupled with a lot of other factors. Some of those factors are the debt to income ratio and how high or low that is. It has to do with what the loan product is, whether it's VA, FHA, conventional, and then beyond that, if it's high balance or if it's conforming. If it's within the conforming loan limits or if it's in what we call jumbo in slang, those are actually two different buckets of money. So the common misconception in that is that, oh, well, it's a higher loan amount, so the interest rate's higher because of that. Well, that's only partially true, but it's that in these two buckets of money, there's a lot more money in the conforming loan bag than there is in the jumbo loan bag. So when there's scarcity of something, it's more expensive. When there's a lot of something, it's a lot cheaper. So that's why sometimes you'll see the difference between a jumbo loan and a conforming loan be 0.25%, 0.5%. It has to do with the scarcity of the money, not just the loan amount. Now, the other thing that we talk a lot about when it comes to loans is really misconceptions of the interest rate itself. You know, you've probably heard a radio advertisement, seen a television advertisement. You've probably seen a little marketing piece on social media or online somewhere that has a quoted rate. Now, I want to make sure everyone understands this. That's a marketing rate. That's a rate that they're using to market to you. What's actually happening behind the scenes is, even as we're recording this right now, the bond market is trading and the mortgage-backed security market is buying and selling and buying and selling and buying and selling and buying and selling. Every single day that the stock market is open, the bond market is trading too. So bond pricing, which creates mortgage rates, is changing in real time every single second that the market is open, Monday through Friday. So you'll see something called intraday rate changes depending on how volatile that day's session is. Sometimes Mike and I can walk in on from the weekend on a Monday and rates are where they were on Friday. But by Tuesday, they're lower by 0.25%. Wednesday, they're back where they were on Monday. Thursday, they're higher than they were on Tuesday. It can change rather quickly, especially in volatile economic times like we're seeing right now. So the important part and the important takeaway is the marketing that comes at you with rates is not consistent with what is actually happening in the background in the rate environment that generates their interest rates that buyers get when they buy a home or people that are refinancing get when they're refinancing a home. One last thought when it comes to the interest rate. The interest rate is ultimately not going to be known until you lock that rate. When you lock that rate has a lot to do with the time you've been afforded in your contract on a purchase to close the loan, whether you have a 21-day close, 30-day, 45, or 60-day close. You can lock your loan really based on what the marketplace and the mortgage interest rate market is doing within the time frame that you're allowed in the contract. So what you want to do is get yourself best prepared with your loan officer and with the loan team in general to make sure that your finances for the mortgage are set up right, but also that you can take advantage of the best day to lock when that day is there. On that trading day between a Monday and a Friday, you got to figure out with your team when's the best day to lock that loan so that when those prices take a dip and the interest rate goes down a little bit, you can snap that thing up. Now you're locked, you continue on in your contract and close escrow on time with Mike.
Now, you mentioned one thing, how your rate can be affected throughout the process from timing or one thing or another. One thing I've seen is that by having or working with buyers who were purchasing a home with a VA loan, they needed some help with their closing costs. And in this situation, they were afforded a lender credit, and that bumped their rate up just about a little over a quarter of a point. So that's one thing that can affect your interest rate as well. Now, you're wondering like, well, why does that go up a little high? But you can refinance that, about 6 to 8 months later with a VA interest rate reduction loan. And we can discuss that more in another day or another video. Or if you want more info on that or interest rates, contact Andy and myself, and we'd be happy to discuss that with you. Call us, text us, send us an email, however works better for you. We're here to help you.
So one of the things that Mike was just talking about when it comes to taking a little bit of higher rate in order to generate a credit towards the closing costs is actually a strategy. You can do this if you're in a tight spot where maybe the finances are kind of there, but maybe not 100%, where you can take down all of the closing costs in the transaction and the seller's contributing nothing. What you can do is actually accept a higher interest rate, which generates an overage, and that overage has to go to the borrower, has to go to the buyer. So what Mike's talking about is, maybe you're qualifying for a 3.0% loan. And then at 3.25, 3.25, the difference of the margin in that actually gets applied in dollars towards your closing costs in the deal. So it may sound complicated, but there's a mathematical formula we figure out that tells us exactly how much money you need in the process to close and how much money you could have with a lender credit by having a higher rate, generating that money to go to offset the closing costs. So as you can imagine, everyone's situation is unique and different, which is why it's important for us to talk about your specific scenario. It's likely that whatever you're facing when it comes to pricing is something we have faced before, but really the general takeaway is what's true for one person is not true for all people. That is for certain when it comes to pricing. So please make sure you're super clear with your questions and that you are asking us everything you want to know so that we can answer it and explain and educate you along the way, so that when we are in escrow on a purchase and we're doing a deal together, you're ready to go, you're feeling confident, and you're ready to buy that dream home because you already know everything you need to know in order to make all the right decisions at the right time. So we hope that this has been informative today. Thank you so much for continuing to watch our video series. We're looking forward to seeing more questions for you and answering more things about how to win in real estate. So for today, Andy Cruz here, Mortgage Heroes, and Make a Move Mike. We'll see you next time.